Hey everyone, welcome back to another episode of TLA. Gaining a clear understanding of the liquidity concept can instantly enhance both your entry and exit points, reduce unnecessary losses, and open up opportunities for extremely high risk to reward setups. In today's video, we'll break down the essential idea of liquidity from a smart money trading angle. You'll learn how to identify liquidity grabs on the chart and, most importantly, how to apply this principle effectively. We'll also share our rule-based liquidity trading method, complete with precise entry and exit guidelines. So if this is the kind of content you're into, hit that like button, subscribe to the channel, and I'll catch you right after the intro. So, what exactly is liquidity? In simple terms, liquidity refers to money. Every trade in the market is a deal between buyers and sellers. When there's more money circulating, it becomes easier for large participants to execute trades. Imagine a major corporation wants to convert hundreds of millions of dollars into euros. If they do this when liquidity is low, the price will spike. Since they aim to buy at a lower cost, they avoid causing price increases. What they need is liquidity, or more specifically, they need sellers available in the market. So the main question is, where can we find liquidity zones? Liquidity exists where retail traders enter the market. We understand that when price reaches a demand zone, it attracts buying activity. And it's not only retail traders getting involved, smaller banks, private firms, and other financial entities also participate in these areas. So, if they place buy orders in this area, their stop losses are essentially sell orders. That means the liquidity zone lies just beneath this demand zone. At this point, the conditions are set for the institution to trigger a liquidity grab. Then, the price makes an aggressive push to the upside. At the top, when price touches this trend line that acts as support, traders will likely enter long positions and place their stop losses just beneath the trend line. This marks our liquidity zone. Below that, there's a key structural level that has recently served as both support and resistance several times. If the price revisits this significant level, it sets up an ideal long trade opportunity. Why? Because the liquidity grab will create the right environment for the price trend to continue, and that's exactly the scenario we're aiming for. What should we be looking for, and what are the advantages of spotting liquidity zones on the chart? First, when a liquidity zone exists just before a demand or supply area, it creates an ideal trade setup. That's because liquidity acts like fuel for the price moves we anticipate. The second advantage of recognizing liquidity zones is that it helps you separate weak liquidity areas from strong demand and supply zones. This can sharpen your entries and reduce potential losses. In this case, price broke a structural level with inefficiency, leaving behind a clean order block. If price revisits this area to close the imbalance, it becomes a great setup to place buy orders. After that impulsive move, the trend weakened, and you'll notice how multiple liquidity zones formed afterward. Then price broke below support, cleared out early buyers, absorbed the liquidity, and resumed its upward movement. Now here's a key point. When liquidity is taken just before hitting an order block, it often sets up a strong trade opportunity. However, this isn't a fixed rule, because price can still break through the order block and trigger a major trend reversal. That's why we always wait for a clear reversal pattern on the lower timeframes before executing our trades. Types of liquidity zones on the chart. There are several areas where liquidity builds up, such as trend lines, consolidation zones, and even major moving averages. However, our primary focus is on equal highs and equal lows. The goal is to keep the concept straightforward and practical so we can consistently apply it to our trading strategy. Now take a look at this example. This is how we differentiate between significant supply and demand zones and areas that simply represent liquidity. Starting from the left, we saw a strong upward move that left behind some inefficiency. Ideally, we'd be watching for price to retrace and fill that gap, allowing us to place orders within the order block zone. Here, an opposite colored candle formed during that move, creating inefficiency, making it a great demand area for potential trades. At the top, there was a key structural level that had recently acted as both support and resistance multiple times, once again, offering a solid buying opportunity. Now that you understand the concept of liquidity, let's jump into our key liquidity trading strategy. But before we do that, if you have enjoyed the video so far, please give it a thumbs up and subscribe to our channel, since it goes a long way to support us in making more videos like this. This trading setup isn't confined to any specific time frame and can be applied across Forex, crypto, and stock markets. It's straightforward and it involves two primary steps. First, we determine the trend using an exponential moving average. To do this, we apply the EMA 50 on the chart and wait for the price to break the EMA in one direction, then produce a series of 1, 2, 3 moves, with the third move breaking the market structure. For example, here the price broke above the 50 EMA, made 1, 2, and 3 moves, and broke the previous market structure, confirming a bullish trend as long as price stays above the higher low. In this scenario, we only focus on buying setups. In the second step, we search for a liquidity sweep pattern. This means waiting for the price to form a support level and either wick below it to grab liquidity or briefly close below the support before moving back above. See how the market created support and triggered a liquidity grab with this long wick candlestick. You can enter right after this candle or wait for a confirmation candle closing above the prior candle. Our stop loss will be placed just below the long wick candle, and our target is the next structural level. You may also consider moving your trade to break even by closing half of your position once the price hits a 1 to 2 risk to reward target. Here's a critical tip. Always check the higher time frame to gauge where price currently sits and how much room it has to reach the next structure level. For instance, this is the same chart just before executing the trade. When we zoom out to the 1 hour time frame, we notice that price has recently broken structure to the upside and still has significant room to move before reaching the next structural level. However, if it breaks the high low to the downside, we'll begin looking for short setups on the lower time frame until price approaches the next market structure level. Remember, everything we've covered also applies in a bearish context, so now, let's take a look at a bearish example. On the EUR15 United States dollars minute chart, we can observe that the market broke below the EMA 50 with a clear 1, 2, 3 move, establishing a bearish bias. Following that, the market formed a resistance level, briefly broke above it, grabbed liquidity, and then quickly returned inside the range. This is also known as a failed breakout, which is where we initiate our trade. As mentioned earlier, this strategy isn't restricted to any specific time frame or trading session, but it's essential to conduct your own backtesting to identify which pairs it performs best on. So guys, I hope you found this video informative. If you did, please hit the like and subscribe buttons. It really helps us continue creating more content like this. And don't forget to drop your thoughts or questions in the comments below. We always try our best to respond to everyone. Catch you in the next episode.